Let's turn to the broader market now with stocks trading right around record levels. Joining us here on set is Gabriella Santos, Chief Market Strategist for the Americas at JP Morgan Asset Management. So you're looking at a lot of the cross-asset moves, and you say that the focus has now been more by monetary policy versus the fiscal and trade and other immigration policies coming out of Washington. How do you expect stocks and bonds to perform with monetary policy at front and center right now?
So I do think after a very policy-heavy first half of the year, driving every single daily minute-by-minute move in the markets, it's a much healthier place to be, a better understanding of equilibrium of policy, and so something that's less of an acute issue, more of a chronic issue for markets. And now the leading narrative has been the return of Fed rate cuts. Now, traditionally, you do tend to see both stocks and bonds do well when the Fed cuts rates, especially if there's no recession. But there is a caveat we would add, and we've been making with clients, which is we don't want to fight the Fed, but we also don't want to swim too closely with the Fed. There are important nuances here of this particular Fed rate cutting cycle that's important to take into account in terms of soggy growth, elevated valuations, curve steepening, weaker dollar. So we can't exactly do a carbon copy-paste of other Fed cut cycles.
Right, because conventional wisdom would suggest that if you are cutting rates, then that could potentially catalyze the economy higher. But you suggest that that soggy economic conditions would continue despite the Fed rate cutting. Does that depend on how much they cut and the extent to which they do, or is that just kind of the place that we're in right now?
A bit both. In terms of the extent, yes, that does matter. And I think we need to remember this is no longer the post-GFC pre-pandemic environment. One important thing is different. That's inflation. That's not a stop sign to Fed rate cuts, but it is a speed bump. That means they're talking about getting back to neutral or an idea of neutral around 3%, just an additional 100 basis points of cuts. So let's not expect that Fed to inject that extraordinary amount of liquidity anymore. And the second is just this economy is less interest rate sensitive. We saw that as rates went up, with the exception of housing. So why would we think it would be different as rates slowly start to come down? So I think much more important will be broader economic policy and how it's shaping cross-asset nuances, as well as the structural drivers there that are super important to the economy and this market around, for example, AI here in the U.S.
And you mentioned valuations and kind of where stocks are in the Fed cutting, despite some of these concerns around valuation, which Fed Chair Powell himself raised concerns about. Is there a reason to adjust one's portfolio based on that? And how do you think investors should be essentially hedging these concerns without giving up potential upside?
Yeah, exactly. It's not to be bearish on equities because you hit a certain level of valuations. It tells us nothing about the next 6 months, 12 months. But it does tell us a lot about expected returns over the next 5, 10 years. And we've now reached a point where multiples are at 23 times. They're more expensive than we started the year, which is some of the highest levels we've seen in 20 years. So that should moderate your expected return. So a lot of conversations we're having with clients now, finally thinking about active within U.S. equities. That's a huge change. And thinking about international equities, given the huge outperformance this year, which we think is just the beginning. The second implication for us is also when valuations get so extended, there is room for disappointment. And as a result, is there a way to take chips off the table? Just at the margin, if there's a little bit too much exposure to equities at this point, too much let it ride over the last few years, there's a way to hedge your downside on a predictive basis with options, for example.
Do you feel like the biggest risk with valuations where they are is still a monetary policy risk if the pendulum has shifted to that? Or is there a risk that something could come out of Washington that disappoints the markets and therefore the pendulum shifts back to focusing on, some of the trade volatility that we saw earlier in the year, some concerns around other types of policy?
I think in terms of policy, it's less policy change. It's more the actual policy impact. And when it comes to equities, it's really the conversation around margins. So it's great for monetary policy that CPI hasn't picked up as much as expected, but that's not a good thing for margins because we know U.S. companies are paying these tariffs at the border. So if it's not showing up in consumer prices, it's going to show up in margins. So I think, is there disappointment in some of that expected margin expansion later in the year and next year? And we think so, yes, especially for consumer-oriented sectors as well as small and mid-cap. So room for some of that recent trade to disappoint. And then the second big one around the AI theme is still, we get this more up and down now because very clearly there's more focus on the capex that's being done. How much of it is leading really to an increase in percentage of cash flow, percentage of capex as a percent of cash flow that's been rising this year, and what is or is not the return on investment of all that hundreds of billions and trillions of investing that we're seeing.
Yeah, and so far the market's been rewarding it, as we've seen with Baba today, as well as Micron plans to increase their spending, but kind of when that shifts becomes a big question, when the market stops rewarding that spending.
And more dispersion we're already seeing beneath the surface, right? Healthy, for example, to see more dispersion within the Mag 7. Not every single one is up double digits. There is more of a focus. Well, is AI really driving that specific company, given the scale of investing? So that's already healthy to see.
Right. Thank you, Gabriella. Appreciate your time.